Hello, everybody, and welcome to our podcast for today, where I'm lucky enough to have Mr. Lucky Velasquez, my brother from another mother, as our
Yes, sir.
special guest for today. How are you, Lucky?
Mate, I am well. I've the last time we spoke, I have got another daughter. That's interesting.
Congratulations.
Thank you, my man. I've had another daughter. Like it's no sleeping, obviously. Her name's Amaya. She's nice and healthy, but any females that has pushed the baby out, all love to you. I don't know how you guys go through it. It's it's crazy to see that.
Yeah. Well, I'm about to head into the same.
Hey.
I've already got one daughter, but we've got another one on the way in 11 weeks. So next time you see me, I might have some toothpicks on the island.
No, we might have the same hairstyle by then, bro. So
Yeah,
all is good, my bro.
yeah. Well, listen, Lucky, we've got a really exciting topic today, which is going to appeal to the masses, no doubt. It's about buying an investment property, no money down. So I believe that you've got a couple of different strategies to help people with that. One for people that are already an owner-occupier and wanting to enter the world of investment properties for the first time without having to use cash as a deposit. But also there might be a couple of little tips and tricks that you have for people that don't own any real estate at the moment and are still wanting to get into the market, no money down. So we're really looking forward to your presentation, Dave. Feel free to share screen and let's get into it.
Let's do it. Just share these guys. Cool. Right, awesome. So, Tim, thanks for the introduction. Right now we get a lot of clients hitting us up saying, "Hey, should I buy an owner-occupied now, an investment now? I can't save 20% deposit. How do I do it?" That's been the common conversation that we hear 5 times every single day. So we thought, okay, well, let's just educate the masses in terms of what does it look like to kind of extract equity? What does it look like to no money down? What kind of lending? What other new lending policies are there for investors to get into it? A lot of them now are kind of going even to 97% LVRs, right? Something that we haven't seen in a very, very long time. So yeah, look, I'll go through this and hopefully you guys get something out of it. And Tim will be casual, but guys, this is parental guidance. I swear a little bit, so apologies, and I'll keep it PG. I will keep it PG, and usually I'm louder, but I got a block nose today, so apologies with that. And again, this is opinion, not advice. So my goal today, hopefully, 20, 30 minutes or so, is how to finance your first investment property. That's interesting. What type of things you need to do? What type of investment properties are going to be harder to finance than others? Yeah, that's a big one. A lot of clients are saying, "Oh, I want to purchase a display home as an investment." What things you need to understand in purchasing those, what securities are harder.
Yeah.
Misconception about no deposit or low deposits, and then, how to get your investment as soon as tomorrow. Again, if you guys don't know me already, my name is Lucky. I'm the CEO and founder of FinanceBetter. And again, look, my opinions have been everywhere. So, I'm very, very opinionated with what I say. I say what I want to say, and I focus on that.
Call it as you
So
see it.
yeah, call it as you see it. And obviously we got the man himself, Tim, with us. Highly regarded, and that's why obviously we got to get the collaboration together. And again, 45 minutes is just a talk. Yeah, I wish I was the rock. I look like the pebble. So I just want to just chat. Let's just talk here. Just let's be casual, and hopefully you guys get something out of it. Stay till the end. I got something for you guys as well. Nothing to sell actually, but it's just something till the end that I wanted to present to the hotspotting crew.
Excellent.
And again, this is the stuff that we wanted to do in this kind of webinar. So let's talk about the hard way first, about in getting into investing, especially if you're trying to get into your investment property. A lot of the hard ways is limited finance options in comparison to what it was before, lengthy approvals, non-conforming lenders, nothing wrong with them, but you get to see a lot more of them, saving a significant deposit. A lot of people still think you need 20%, and because you need to do that, you got to sacrifice your lifestyle.
Yeah.
And I want to kind of, break that down. And why are a lot of Aussies kind of failing from that? It's very, very simple. I point this in every webinar we'll do. So Tim, as the 50 webinars that we'll do, this slide will always go through. Why do we keep seeing failures in property? It's not your fault. We just get taught from people who have bought a property for 20 grand, 30 years ago, and suddenly they're a property investor. So we get taught the wrong principles. Our culture can shame success. There's a lot of 100%. The only thing you should buy is an owner occupied, pay that off and die. Many of us are raised to be overly skeptical. If it's too good to be true, buy two. So, and there's nothing wrong with being skeptical, but it's just understanding that don't block yourself from hitting an opportunity.
Yeah.
And the result of us that we don't have a plan. And I'm saying by plan, even a savings plan, right? Like plenty of our clients come to us and I say to them, hey, you could buy a property tomorrow. And then suddenly they have a little bit of savings and they're like, well, I need another 10 grand. There's a clear plan to get there. And they buy something in, say, 2 or 3 months' time. So just putting a bit of a plan together. And again, we never set up a plan and follow that. So, and we never really look outside the box. Yeah. When someone says you could buy something,
we go to the same lender we've used for 20 years and say, if they can't do it,
100%. Yeah. Right. Or no, like there's no such thing as a 97% LVR because my bank hasn't told me about it. It's just like, well, that's your bank. Like you haven't gone out there and done the research, real deep research, and other lenders that can do 97% or 95% LVRs. So let's start. What could you do? Yeah, cool. Whoo. Let's do this. Let's do this. I'm pumped, baby. Let's go. Let's go. You could save 20% deposit. You could. Yeah, nothing wrong with that. And yes, you're taught to save 20% plus stamp duties. But how could you? You guys, inflation has happened. A lot of things is going on, right? It's really hard to save for deposit. Nothing wrong with that. Okay. I'm not saying it's hard to save. It's just harder to save for a bigger deposit. Now, the question is, usually, how long does it take for property buyers to save 20%? Usually, it's 4 years and 9 months. I want to just say 5 years, but 4 years and 9 months. I'm going to break down some data, and hopefully, that's going to give us an understanding what it is. So, let's think about that for a minute. Long time, right? Anything can happen in 4 years and 9 months. It took me 9 months to have a baby. Yeah. Yeah. 10 minutes actually, but then 9 months for that baby to happen. Yeah. So a lot can happen in 4 years and 9 months. So year one, let's have a look at this. This is some stats, 20% deposit, what it is, 800 grand, 160, 595, 119, et cetera, et cetera, et cetera. You guys get the gist here. You know, that's what 20% deposit is. Then we look at the average growth, right? And I've put there 20% deposit at average of 4 years and 9 months at 5% property growth. And you guys can see what that looks like too. 160 becomes 2001. Yeah. So unless you're aggressively saving and not really eating, 119 becomes 150. You guys start to flow with me here. So
just
when people start to say,
further away,
100%, and you could, people tell me you could save, and there's no doubt about it. Great. Kudos to you. But can you save as quick as the property growth is happening? Yeah. And to most of the people, it's no. And that's okay too. But the thing is, they can do it now. They just refuse not to. And we'll break that down. And again, it's not just 20%. You also need stamp duty, as you know. Hey, Tim, SA, stamp duty is that
high? South Australia quite high. Yeah. It's actually that stamp duty and transfer, and the transfer is exorbitant.
Yeah. We're getting a lot of SA stuff, but at this good enterprises, stamp duty is a bit more. Obviously, there's loan application fees. There's fees for lands and titles register, which is kind of what Tim has talked about. Building and pest results. Some are $500, some are a couple of G's, depending on obviously what property you're buying. Have a solution, which is good. So now I want to kind of go into what you can do into what it is. So equity release, a cash out equity, best to do it IO, attach money and offset until you're ready to use it. So here's a nice little graph of what I've done. Now, again, this is going to be personal opinions here. You talk to your accountant. So let's call this illustration in the middle as your owner occupied debt, right? You've got 500,000 of owner occupied debt. You want to cash out of that debt, interest only preferably. And then that way you can really claim that back. Now, it doesn't matter if it sits on your owner occupied debt, you could still use that as a tax minimization strategy because you're using that towards buying an investment property. So if, for example, you do cash out of your owner occupied home, let's call it $100,000, right? And use that 100 grand to then, buy the investment property. The interest, even though it sits on your owner occupied, is tax deductible. And so is the interest on the investment. The caveat is if you use 100 grand and I come to your home and you have a 100 grand Mercedes at the front, you can't say you could claim that back on interest. You could buy the Mercedes, fantastic, good for you, but you have to make sure that the purpose for that is for investment use. And why we do interest only? Yeah, why we do interest only? there's nothing wrong with IO and P&I, but we use interest only because you still have an owner-occupied debt that is non-tax deductible
Yeah,
that
so
you
that's
should be paying
about
down
focusing on paying down the
principal
yeah,
and interest, and again, you only pay interest on the balance
yeah.
being used.
Yeah, it's
which is
probably worth noting there. Like, if you took out, 250,000 and you only used 100, you're still only paying interest on that 100.
100%. Actually, the big thing that you've mentioned, actually, which is not what a lot of people really understand, is when you cash out principal and interest. Okay, understood. Your interest can sit in the offset account, but you still actually have to pay principal, right? Being it interest only, your repayment is only with the money that you are being used. Yeah.
Yeah.
So that not a lot of people really understand it. Like, how come my repayments are the same? And I'm just like, well, there's principal component towards that now. If you leave it as interest only, again, you use 150 grand and there's 150 grand, 300 grand limit. Well, you're only paying interest really on 150. The 150, you don't make any repayments on it until you've used it.
Yeah.
Which is good.
Yeah.
And again, this is a big one too. It's like, stop using all the cash out that's being used. What we're trying to understand here is work out the minimum contribution. Minimum contribution. We say contribution, we don't say deposit, because contribution is everything: stamp duty, cost, etc. Right? So the understanding here is to use minimum contribution. Yeah. So here is some breakdowns, and I've taken a couple of screenshots for you guys. I've done 3. I've done one at 90%, I've done one at 95%, and I've done one at 80%. Yeah. Just to get some numbers flowing to us. So in this scenario, I used WA 550. Yeah. The stamp duties, all that stuff, etc. Is going to get us to a contribution of 89,000 approximately. Yeah. After all your costing, the contribution is 89 grand. So that's that. Then you got one at 80% LVR, right? So you got 90,000 and you got here at 80% LVR. Same property, same stamp duty, same thing. Here, the contribution is 133,000, 134 and change. And the last one is 95%. Same property, exactly same thing. But here, the contribution is 68,000, right? Big difference. You got 68, about that 90G, and you got that 1X, right? So 68 Gs. Now, the question is, to acquire the investment property, what would you rather? Use 150K contribution or use 68? Yeah. The common answer, even though you may think, oh, we should use the 68, the common answer is actually the 150K contribution, because that's what all people know. They're like, well, I just want to put in 20% deposit and then that's it.
Avoid the lender's mortgage insurance.
I understand what's the hate with LMI. I don't get it. Like, I can understand it from an owner-occupied point of view, and this is a great topic, Tim, and I'm so glad you kind of picked it up. But owner-occupied, I get it. The person making the repayments is you, sure, right?
And it's non-tax deductible.
Non-tax deductible, exactly it. LMI contribution, well, it's usually added towards the loan. It's inclusive of the loan. The debt in itself is tax deductible. The repayments, if you get obviously a good location, most likely going to come from the tenant, considering what the yields are right now. Why wouldn't you have the minimum contribution to acquire it? It makes complete sense to do so, because then you're not taking too much of equity. And if, for example, something happens in your life, it is an emergency, whatever, you could have that equity to use that. You could acquire the second, third, fourth, fifth property that you didn't know you could, just because you dumped all your equity into one property.
Well, I think it's like a similar conversation to, if I've got a borrowing capacity of $1 million, do I buy one property worth $1 million, or do I buy two worth 500? Or, with costs maybe a little bit less than that. But if we think about equity in the same way, if I've got 200,000, do I put 200,000 as a 20% deposit into one property? Do I split that across two, which gives me diversification? Yes, I'll pay LMI, but I've got two properties in two different markets, both going up in value, hopefully. So that's really the question, isn't it?
Yeah, it's the power of hedging, and that's what it allows you to do. But yeah, love it. And again, you could get away with 5% deposit now. Before, this wasn't really accessible to a lot of investor clients. We have one bank that is 97%. Yeah. And there's 3 or 4 lenders that could do 95% inclusive of LMI.
And Lucky,
So not a lot
when
of
you're
people.
talking about these loans, are we talking about a plain Jane established property? Are we talking about, can we get a type of LVR on a construction build at the moment?
Ooh, I love this question. Yes, you can.
You can.
So initially we thought it was only for established homes,
Mm,
which kind of made sense. Established homes, less risk for the bank, but there's 2 lenders out of those 3 or 4
mhm,
that can do house and land or land and construction or brand new, sorry, with construction, um, at 95% and
Yeah,
97%
wow.
LVR.
I
So
haven't seen that in years.
yeah, no one has.
Mm,
And again, unless you start really opening up the conversation regarding investors,
mm.
you probably won't know neither. Yeah.
Yeah, okay.
Um, so
And
that's
is there any other
that's
stipulations around being able to pay interest only or principal interest? Are they available as interest only loans?
so on 95% and 97%, it is the higher LVRs.
Mm-hmm.
There's 1 or 2 lenders that will do interest only. The bulk of these guys will do principal and interest up until you're probably at that 90% LVR mark, which is kind of
Yeah,
that healthy mark between the bank
yeah.
risk appetite, of which you could then turn it to interest only. Yeah.
Okay.
But the contribution is smaller. Again,
Mm,
you're kind of going into the property at 5%, or you're acquiring it with lower contribution.
yeah.
If it's a right property, the capital growth should be there in the next couple of years. You
Mm.
do evaluation in say 6 months, 12 months, 24 months, etc. Once the LVR capacity then does it, then we go, okay, fantastic. That's when you just switch it to IO
So,
within a
Lucky,
couple of
something that might be interesting for our listeners today. One property that I purchased at 90% LMI, and this is actually before I married before I married my wife who worked for NAB, and I could start to get loans
Okay,
at
okay.
90% with no LMI. But the
Look
first
at now.
property that I purchased with no with only a 10% deposit, and I had a 90% LVR. I paid LMI on that, but I actually refinanced that loan
Mm,
probably about 12 months later. And
mm,
interesting, the reason I did that is because I, bought well, got great growth and wanted to tap into an equity lease. And then all of a
nice.
sudden I got a check in the mail from Westpac saying, here's your refund on the LMI.
There
So,
you go.
so LMI isn't always, whilst you might pay it, if you're not using it for the full length of that term, or if you're refinancing within 12 months, I believe it can be,
12 months.
you may be able to get some of that LMI back.
Mhm.
Is that?
That's correct. Yeah, you just have to
Yeah.
we just look at the policy, obviously, which lender allows for it. But yes, you can.
Yeah. So if
Usually
you're buying in
it's
a
12
market
months.
that you're confident in, and very quickly gain 10% worth of growth, you may be able to be entitled to getting back a refund on the LMI.
We're seeing 10% growth now
Yeah,
in
that's right.
multiple areas. So
Yeah.
it's not an uncommon thing to see that type of level of growth.
Mm.
Yeah, of course. Love it. And again, we just talked about this. It's funny. But yes, what's the hate with the LMI? Like, especially being an investor, like there's nothing wrong with LMI.
So
Um,
can I just quickly touch on one more thing on there in
of
terms
course.
of the use of a 10% deposit versus a 20% deposit? The one thing that we haven't touched on there, you may be
Mm,
paying some LMI by doing that. But here's the difference. If you were to put cash into a transaction, so you're using cash as a deposit as opposed to equity as a deposit, the other
mhm,
tax implication is that in order to save a 20% deposit in savings, I'm being taxed on my income. The thing that
mm,
people don't understand about equity is tax-free. So I can leverage 100 grand, 200 grand worth of equity to go into my next property, but I haven't had to
love it.
pay tax on that income.
Love it. Oh, Tim with the nuggets. Far out. Love it, man. Fantastic. Cool. Next one. What else can you do? You could go as co-borrowers. There's been a big hype about co-borrowers, especially for borrowing capacity. What does a co-borrower mean? Basically, when you decide to purchase a property with a person other than your spouse. I'm going to talk about the negatives and the positive with this specifically. Yeah. Because this happens to a lot of migrants. I'm Filipino. I man, every person that's Filipino has added their kid onto the loan, and it shows me that you don't love them enough. No, I'm just joking. I'll show you why in a sec. Why it's not. So it's fantastic up until the co-borrowers don't see eye to eye.
Yeah.
Yeah. So it's very, very important to understand that with 2 co-borrowers that is not having the same life, you are going to come to a hurdle where one goes left, one goes right. and there's nothing wrong with that. It's just called life. Yeah. The kids that's usually added towards a family home, for servicing point of view, I get it. Will most likely marry themselves or decide to live their life and wanted to buy their own properties. By attaching them to that property, they are restricting themselves for growth. Yeah. Usually we see a aggressive, drastic removal of any borrowing capacity happening. Just a heads up. And I'll show you that in a second. So this is what's called common debt. Very important to understand this, right? And I don't know why no one really talks about this a lot, but I will. But common debt is basically, let's say, Tim, I'm going to just use you. Yeah.
Yeah. Go
We
for
have a property, me and Tim. I own 50%. Tim owns 50%, right? So what ends up happening is the debt. Some banks will look at my portion, as if it's 100% portioned. So it's mine and Tim's debt. I'm just like, hang on, I only owe 50%, and I'll be making repayments of 50%. The bank doesn't care about that. They'll say no.
Well, what happens if Tim stops paying?
100%. What happens if something happened to Tim? Knock on wood, right? So you owe that, and the thing about that is they won't even take the percentage of income, like the 100% of rent. You'll take the portion of rental.
You get all the bad, but
rehab.
not all the good. So you get 100%
Exactly
of the
it.
debt and 50% of the income.
That's right. So that's what's called common debt. Very important we talk about this. And it's very important if, for example, you do have a strategy with people that is not with the relationship, de facto married, etc. Very important that you sit down with a broker, a financial planner, your buyer's agent, and just go, this is our strategy. And what is that exit clause for that strategy? Very important.
I think this
Should
is
always have an exit
I
clause.
think this is a really important part for people to listen to. If you're, I see this all the time. Two young, professionals that, are living their own life, earning good incomes. They get together and they go, "Hey, let's buy a property together." And maybe they start with investment. And what happens is they buy at 50%. And as Lucky's just said, the next time they go to borrow again, whether they want to do something on their own or together, the challenge is that you both need to be able to service both of those debts. So if I decided, hey, look, I want to go out and buy another property, but my partner's not willing to do that. When I go and try to buy something on my own, the bank is going to look at me and say, well, you've actually only got 50% of the servicing on the existing property, but you're liable for 100% of that debt. So it can really cut into your borrowing capacity.
100%. Like, again, we've had multiple people like come to us and say, hey, I want to buy my second investment property. It's like, cool. Is your parents down for it? No. Is the partner down for it? No. I'm just like, so what do you expect to happen? The borrowing capacity is just not there. So what's usually what had to do is someone has to buy usually someone out at fair market value, which then implies duty to be applicable on the new valuation on the component percentage that they own, which is it's in my opinion just not worth it. Again, nothing wrong with it, but just know what it looks for.
Yeah.
And again, a lot of banks know what you're trying to do. So if, for example, you are doing common debt and you kind of apportioning a certain percentage to let's say, I'm on 300 grand and Tim's on say 20 grand. I go, okay, Tim, I'm going to give you 10% of ownership.
Yep.
Banks know what you are trying to do. And they will treat you as if you own 100% of that property. Even if and I've seen this multiple times where kids are there 1%, 2% of the property. Yeah. They don't care. The banks are just like, well, no, so you own 100%.
It's probably worth saying this is all well and good thinking about this prior to purchasing as a co-borrower. But if you find yourself already in this situation, it isn't, completely the end of the world. There are some lenders that will take a stat deck to say, my partner's not working, she's staying home with the kids, and I'm 100% liable for the debt, but also 100% receiving the income. Sometimes they will allow you. Sorry, the other way around. They will say that your partner is contributing 50% of it, so you can actually move to the next step. Is that right?
Yeah, correct. That's right. Yeah. It's just understanding which lender will do that, obviously.
Yeah.
Last one, my favorite one, security guarantor. Yeah. So we talked about 95% lends, 97% lends, minimum contribution, good. Security guarantor. So kind of no deposit. this is the most important one here. Yeah.
Yeah.
And I'm going to go to my bass voice, my bassy voice here, my chest voice. And I'm going to be like, this has not only grown my property portfolio, but has allowed my sister to grow their portfolio. There's a lot of misconceptions to the guarantor,
Yeah.
and let's just kind of debunk this now. Yeah.
Yeah.
So what it is, security guarantor is basically there's two types of guarantee, right? There is servicing guarantors, yeah, which is basically a co-borrower, and there is security guarantors, yeah, servicing and security, right? To make it simple, servicing guarantor is basically when they are on your title, like they own the property with you. You could call it co-borrower or any other crap that you want to call it, but that's what's called servicing guarantor, yeah. And that's where a lot of guarantors usually get stung on, because they're like, well, if my kid decides to, I don't know, go to Bali and become a digital nomad, nothing wrong with that for the next 30 years, right? Cool. But I've got to take care of this debt. And if something has to happen, it's on me.
Yeah.
Security guarantor, not saying that there's no risk, but security guarantor offers the most minimal risk for it. Yeah. And I'm gonna just go here. So usually 105% can be funded, meaning 100% of the value of the property. So let's call it, if the property value is 550,000, your loan is 550,000, which is 100% plus costs. If stamp duty is 20 grand, your loan is the 550 plus the 20 plus change. Yeah.
Yeah.
That's good. The good thing as well is there's some lenders that can go guarantor that will fund any BA fees too. So if you use a BA, you could actually get funding also on a BA with guarantor, which is great. Not a lot of people used to do it. Not a lot of banks to do that. You could do that now, which is I think is fantastic. Cool. There's we made this. Me and our design team drew this because I tried to get something on Google Images, and I didn't understand any of it.
Yeah.
So this is the best way that I will tell that to illustrate this.
Yep.
So number one, this green property is the property that you're buying. Yeah, it's 600,000, right? Cool. This dark one here is your parents' property, which is that 20% mark. See what it's done? All it's done is it's just securing it against that 20%. And what will end up happening is over time, you pay the debt, the property grows in value and you disconnect it. That's it. If you have an active broker, right, or you have an active bank, or you should be active, order evaluation every 6 or 7 months, work out a repayment plan to do it. And especially if you're buying investment and you want to kind of remove that as guarantor pretty quickly, accelerate it with extra repayments. You've already got the tenant paying for it. You make some extra repayments, work with the broker to be like, okay, cool. I want to disconnect this in say 6 or 7 months time, and you disconnect it. Yeah.
Lucky, I think this is one of the most powerful products on the in the finance markets right now. Like the amount of people that may be saving up, they might have a 5% deposit or a 10% deposit. They've got to pay stamps, all these different things. They've got the opportunity to go to the bank of mum and dad and say, look, I don't want you to be a guarantor on my loan, so to speak, meaning that if I stop making payments, you've got to start making payments. What I want you to do is say, listen, I've got 50 grand sitting in a bank account, and it's not going to get me far. But if I was to put 50 grand in your savings account, and then you went guarantor as the deposit on my property, then if I stop making payments at all for the deposit, you're liable for the deposit repayments, but you've got 50 grand of my money to cover the repayments in the event that I lost my job or unforeseen circumstances. So I've recommended that to a lot of customers who have gone down the track of doing that. It gives your parents peace of mind, but it allows you to get into the market with no lender's mortgage insurance.
Yep.
Right? It's a huge saving, and it gets you into the market at a hell of a lot lower risk for both you and your parents.
Again, I think the biggest misconception regarding hearing the guarantor is the first word at the start, right? When you hear guarantor, you're just like, oh man, it's so negative, and everyone's had, someone's had a terrible experience. The first word will tell you if it's a terrible experience or not. If they said servicing guarantor or security guarantor, it will tell you straight away. I'm like, okay, cool. And why? Was there a proper plan in place to then do so? Like when I first bought my first property, we had, and this personal example, I had some money. right? That money was enough for a 20 or 30% deposit on the house that I wanted to buy, right? But we needed that for cash flow. We needed that for the businesses. We just needed that to as a safe buffer. So we went as security guarantor. I gave my mom and my dad the money, some money, and I said, "You hold on to this, right? Just to hold on to something." They didn't really care, but they were like, "Okay, cool." They'll hold on to it up until it's disconnected, because there was a property, but the property growth was accelerated, and because I made extra repayments towards that, we disconnected that with about 11 months time, right? Now, in security guarantor, does the parents have to be working? The answer is no. Yeah, it doesn't need to be working. If it's a servicing guarantor, they need to be working. They have to be assessed on their servicing, their ability to pay. On a security guarantor, it is not. It's just the property. That's it. Yeah. Can you buy multiple properties with security guarantors? The answer is yes. You could buy multiple. So if, for example, you wanted to attach another 2 or 3 properties, depending on obviously the valuation of your parents' home, yeah, that's enough for you to just start growing your property portfolio pretty aggressively.
I'm sure there's a lot of listeners out there now, Lucky, that, you know, are in a position where they've got quite a bit of equity in their home and love to do something for their kids, but, you know, to be giving them cash or to be, you know, trying to give them lump sums and things like that is incredibly difficult because they're trying to pay down their own debt. But this is a really good way to help get your kids into the market, help them with a leg up without taking on huge risk.
Just one more thing. I'm gonna just, this topic is so important. Some parents go, well, you know what? I want to help out my kid. Yeah, which is cool. I'm going to go to the bank and I'm going to take a cash out of 100 grand, right? And then give it to my kids and they could then buy. Try not to do that. The reasoning why is, number one, you have to then service your own. If, for example, you're of age, at times it's going to be harder for you to get the cash out. The second thing is you're paying interest on that cash out. When you give that 100 grand to, or 200,000 to your kid, whilst you love him, your kid is not going to be focusing on paying your debt that you've taken out the cash out. They're going to be focused on the debt that they have currently.
That's a really good point.
So who's going to be focused on paying that cash out? It's you. Yeah. This avoids all of that. This avoids everything. If, for example, let's say you guys have a personal argument in the family and you go, well, you know what, whatever, sell the investment property. It's very simple. You guys have a personal agreement with that cash out that you've taken. It's going to be a far harder conversation going, give me back my $100,000 because I've got to pay back the cash out that I've given you. Yeah. And I see that happen so many times. And I'm just like, there's no point cashing out. That's higher risk. Just do the security guarantor. We'll put a 10-month or 12-month plan to remove it. It's very simple.
Yeah.
That's how you do it. Yeah. Screenshot this. This is important. And this is the only illustration that I got, by the way. Everything else, I think is just to get everyone
I think it's a good representation. Yeah.
Cool. So again, pretty simple on that. I think we talked about that so many. I want to just miss out the slides. The last one here I want to talk about is the afterpay of property acquisition. Yeah. So we are not affiliated with Future Rent as FYI. So we're not affiliated by them. But have you heard of Future Rent, Tim?
Yeah. They're good.
Yeah. Cool. So Future Rent, what is Future Rent? It's basically an advance on rental. I want to read this. It's a service where you advance your current rental. Doesn't work as a line of credit. It's not really a credit provider. And they just take a share of your rental. So if you're getting $800 a week in rent, and you advance 2 years worth, it's 84 grand. Remember I talked about the other slide, minimum contribution? Yeah. That's enough to get your minimum contribution.
Yeah, that's right.
Right. So with this here too, again, it's not a credit provider. How they get their money is through fee, which is a portion of your rent. Meaning, if, for example, it's not being rented, well, they ain't getting paid. So that it's based on the rental, which I think is fantastic. I've got a couple of clients that have used this because they wanted to accelerate their portfolio, and they were like, you know what, I don't have any more deposit left. I don't have any equity left. I don't have.
Basically, they're simply they're giving you rent giving you future rent. They're giving you an advance on the rent that you're going to get, and then they'll take it out in dribs and drabs over the next 2 to 3 years.
Exactly. So that's what it is. And again, unlike a loan, Future Rent doesn't have any repayments. Is it questionable on the CCR? Can you see in the CCR? We have yet to see a Future Rent inside your credit file.
Won't be in your credit file, but it will be on your rental statement. So obviously, if you're going for a loan, it will state it on there that you're not receiving the full rent. So essentially, you might be getting a 4% rental yield on your investment property. You can pretty much halve that.
Correct. But if you've got a very good yielding property, minimal, with a good upside, I think it's a great solution. So again, this is how some people feel like. I know it felt like me when I was doing this. It was a bit intense, but it is what it is. And is there a better way? Yeah, absolutely. So, we see opportunities. I see a duck. Tim sees a rabbit. My son sees Shrek. I don't know, but we see opportunities. And let me ask a question regarding what that looks like. You got two choices here: do nothing, or find out what options you've got. It starts with a conversation. And every presentation, I'm going to finish like this. It starts with a conversation. You have a red pill and blue pill. A do nothing pill, or just have a conversation, see if you could do it. I had a meeting 2 days ago. Clients, 5 years trying to save up. 5 years. They're like, Lucky, we can't do it, etc., etc. Young guys, and they were like, oh, we just wanted to have a conversation to do it. That one meeting, 5-minute meeting, I found out that the parents' guarantor. I found out that they could do it. After that meeting, we did the pre-approval for 2 investment properties. They're now going through the acquisition process to then do it. 5 years of trying to save, right? They could have wiped out all that time with one conversation.
It's an opportunity cost, isn't it? You haven't just lost 5 years. You've lost 5 years of growth.
Oh man, stop
it. And in fairness, in a lot of our lifetimes, this last 5 years has been exceptional growth, and maybe something we won't repeat.
No. Yes, 100%. So yes, and again, the real question is, what are we going to do? So, for all our guys here, whoever's listening, we'll do evaluations on all the properties. Even though it's desktop, it's nice to get some bank vals to be done. We'll review the structure, see if there's any equity position to work on. What minimum contributions you could go to? What cash outs can we go up to? You can cash it up to 90%. And then happy to advise where opportunities are, obviously in collaboration with Hotspotting and their phenomenal software. You guys can see where the true opportunities are, and it will tell you from a financial point of view where you could do, how you could do it. And again, just have the conversation. And again, this is just your equity conversations that we've kind of had before.
Excellent.
So there's no point saving for 20% deposit. Just go with guarantee what it is. So there's 2 more slides. We are going to start putting a Money Matters kind of podcast together. We'll be talking about people, not really professionals, and seeing what it is. And a lot of my clients wants to know about their next door neighbor who's acquired 2 or 3 properties. Some of my clients also want to hear about the person who just bought their first investment property. So we want to hear real people, real stories. And I want to know your stories too. So even if I can't work with you guys at a professional level, it's nice to network. It's nice to say hello to people. I'd love to hear your story. These are my handles. You can see me doing all my dances on TikTok. So that's me.
Well, Lucky, there's 2 things I'd like to comment. One is that it was a fantastic presentation, heaps of great content in there. And 2, congratulations, you didn't swear once.
Man,
that's a new record for you.
Man, you got me excited actually. Wow,
You've done very well.
I didn't swear once.
Yeah. No, not once.
Wow.
No, I'm sitting here with the beeper just in case.
Man, I'm ready on the button. When you have a kid, you're a new man. Like I feel good. I feel good, man. So it's a maturity coming through. No, it's good. It's good.
All right, mate. Well, I really appreciate your time today. For anybody who wants to reach out to Lucky, you can get him at financebetter.com.au. Highly recommend, even if you don't know what you're looking to do, you just know you want to do something. I call it financial progression. You don't know what the actual move is next. You just know that you want to do something and move forward. For financial progression, all you got to do is jump on to financebetter.com.au, reach out to Lucky and his team, and I'm sure you'll be glad that you did. Lucky, awesome. Thanks so much for joining me again today. Let's do this again soon.
I appreciate you. All right, Tim. Take care, guys. Man. Have a great day. See you guys.
Soon.
Bye now.
Thanks.
Bye.